Well, market narratives have been in flux all year, from recession and sharp rate cuts early in the year to hopes of a soft landing and more recently a higher for longer interest rate backdrop. As a result, markets are adjusting to the new regime filled with greater volatility. According to BlackRock, the world's largest asset manager, the current environment creates opportunities. So for more SABC News markets presenter Nastassia Arendse spoke to Laura Cooper, senior macro investment strategist at BlackRock.
I think what we're seeing from market sentiment is that it is quite cautious, and I think that reflects this high degree of uncertainty, whether we think about on the inflation front, as you mentioned, or the economic outlook. We're still waiting for some of these recessions that have been well telegraphed but have yet to come through, particularly in the US. And I think that does keep investors cautious, particularly as we look at some of those traditional relationships, like between stocks and bonds, is clearly breaking down against this volatility.
So we've been talking about quite a lot, whether it was rising bond yields last week or geopolitical risks this week. But let's talk about those rising bond yields. Have we reached peak in those long-term treasury yields? And if so, what does it mean for equity markets?
I think it really depends on the time horizon. I think the pace of the sell-off that we did see in bonds certainly surprised investors, and that largely reflected investors kind of looking for that higher compensation in taking on long-term debt, because we think about this is an environment of higher inflation, higher for longer inflation in this new macro regime. So the sell-off in bonds really reflected rates repricing to that higher level. So I think in the near term, we could see some stability, particularly as we are seeing those Fed policy members suggest that the backup in yields has actually tightened financial conditions to do some of their heavy lifting. So we could see some relief for bonds. But I think over the medium to long term, one of the reasons why we're still quite cautious on US government bonds is because of this higher inflation environment, this public debt loads that are going to come back into focus. And with respect to what that means for equities, well, I think as we saw through September, we did see the simultaneous sell-off between stocks and bonds, and it really just captures this new environment where we are going to have to be more nimble in setting asset allocation. And I think it does suggest that there is still need to be cautious in selecting equities, but it's about being really selective and granular, where we think a lot of that potential economic damage is already in the price.
On that note, I see that you find European bonds more attractive. What's attractive about them?
Well, I think it's a very different growth and inflation dynamic in Europe relative to what we are seeing in the US, but yet European government bonds have been caught up in the sell-off that we have seen in the US. So if we think about Europe, Europe is likely in a recession now, or if not by the end of this year. That's what all of the leading economic gauges, like those PMI manufacturing indicators, do suggest. But then at the same time, we are seeing inflation ease as some of those food and energy prices fall off of those headline indices. And if we think about the wage dynamics, we're likely past the point of peak wages in Europe, which has really been a key underpinning strength of that inflation. So we do think that this environment of easing price pressures and the central bank, probably at the end of their hiking cycle now, we do think are supportive for taking on more exposures in that European government bond space.
The one thing I also found quite interesting is that you went overweight Japanese stocks last month. Why does Japan stand out?
Well, Japan stands out for a couple of factors. I think the first is that we are seeing this return of inflation, and corporates in that kind of equity market have really proven that they have pricing power in this type of environment. And as well, if we think about this kind of long-standing regulation potential changes, we are starting to see greater signs of that. We had the Tokyo Stock Exchange earlier this year implementing corporate governance rules, which really did suggest that they're more shareholder-friendly type of policies coming through. And I think investors are paying attention to that. So we have seen, investors allocate to that in terms of the flow picture as well. So despite us being cautious on developed market equities, Japan is really the standalone at this juncture.
If you had to look at all the central banks right now, what do you think is the biggest question in front of them?
I think for central banks right now is have they done enough in tightening policy? We're certainly hearing from most of them that they're probably at the end of their hiking cycles. Potentially the Federal Reserve has one more given the resilience of the data that we have seen. But I think arguably the Bank of England, the European Central Bank have lightly hit that terminal pause rate. And I think the key question now is inflation going to fall back meaningfully to those 2% targets where they can keep rates at these levels? And I think the key question for investors is how long can central banks keep policy rates at these restrictive levels? Because that's certainly the messaging coming from central banks, that they're not in a hurry to ease policy. And I think that will be the key question, particularly as we start to see more of that growth deterioration come through in the data, particularly in the US early next year.
Third quarter U.S. earnings season kicks off today with the banks. Going into this earnings season, what are market participants looking out for?
I think market participants will be looking out for the commentary around the outlook because there is this heightened degree of uncertainty around what the demand picture will look like, and as well how inflation is actually fed into corporate bottom lines. And I think from an investor perspective, the earnings estimates overall still appear too optimistic in our view. And we think we're going to see this greater dispersion come through into equity markets. So those sectors that can beat those elevated, those high bars of expectations are likely going to outperform. And those sectors that are unable to, I think, are going to be increasingly challenged. And it does suggest really the need to be selective in looking at a sector approach. So we think tech leadership, for example, can persist in the US because of strong earnings, but we think other sectors will be quite challenged because of the headwinds that I mentioned.
As we wrap up, what do you make of the AI play right now?
So it's interesting because at BlackRock, we actually implemented this new theme in our 2024 or Q4 outlook around harnessing megaforces. And artificial intelligence is a key one of those themes. And clearly, artificial intelligence hype has been a strong driver of the tech gains that we've seen year to date. And we think there's actually scope for this to persist on a medium-term basis.